Ever wondered if your investment returns are actually worth the risk? The Sharpe ratio can tell you that in one simple number. In this video, we'll break it down the easy way, so you'll finally understand how to judge an investment's performance properly. Quick disclaimer before we start. This video is for educational purposes only. Talk to your financial advisor before making any investment decisions. Let's jump in. Every investment carries some level of risk. The Sharpe ratio acts like your personal balance scale, showing whether the reward you are chasing actually justifies the risk you are taking to get it. In simple terms, the Sharpe ratio measures how much extra return you are earning beyond a risk-free investment, like a government bond, for the amount of risk you are exposed to. A higher Sharpe ratio means your investment is performing more efficiently, giving you better returns without taking unnecessary risks. Here's the formula. Sharpe ratio equals your portfolio return minus the risk-free rate, divided by your portfolio's volatility. Volatility simply measures how much your returns fluctuate. The higher the volatility, the riskier the investment. Let's make that simpler with an example. Say your portfolio earns 12%, and a risk-free investment gives you 4%. That's an 8% excess return. If your portfolio's volatility is 8%, your Sharpe ratio is 1. That means you are earning 1 unit of extra return for every unit of risk you are taking. Here's how you read it. A Sharpe ratio below 1 is below average. You are taking on too much risk for the reward. Between 1 and 2 is good. Most solid investments fall here. And if it is above 2, that's excellent. It means your portfolio is handling risk beautifully. Remember, the higher the Sharpe ratio, the better the risk-adjusted performance. The Sharpe ratio allows investors to compare different funds on equal ground, even if they have different risk levels. It highlights how well a fund manages volatility. And most importantly, it keeps you from being blinded by high returns that might come with equally high risk. Here's the twist. A fund with a slightly lower return can actually be better if it has a higher Sharpe ratio. That's because it's generating steadier, more consistent performance. In short, it rewards the investor who values stability over short-term spikes. Of course, no metric is perfect. The Sharpe ratio assumes markets behave normally, and we all know they rarely do. It also overlooks extreme events like crashes or sudden rallies. And since it's based on past data, it can't always predict future performance. In India, analysts and mutual fund investors often use the Sharpe ratio to compare funds. Typically, Indian equity funds show ratios between 0.8 and 1.5, quite healthy for a developing market. Debt funds usually score lower, but they offer stability instead. To sum up, the Sharpe ratio tells you how efficiently your portfolio converts risk into reward. But don't rely on it alone. Pair it with other metrics like the Sortino ratio or alpha. The goal isn't just to chase higher numbers, it's to build consistent, long-term wealth. Thanks for watching. Check out the description for extra resources and related videos. And if you found this video helpful, give it a thumbs up and share it with someone who's trying to make smarter investment decisions. And don't forget to subscribe to Secure My Wish, where we simplify finance, one concept at a time.